right, welcome to REI 101. I am your friend Austin from Houston. This is my brother Alberto Medellin. How are you doing today, sir?
Man, I am doing good. It's just one of those days, man. Usually, Mondays are reserved for our call.
Yeah,
So I usually don't have anything planned. I just want to make sure that I'm on time. And I had to go do some stuff this morning that could not wait till tomorrow. And I was trying to get back and I was trying to fit some other things in. And I made it
you're
on
here.
time. So,
You are here.
but yeah, I'm good, brother.
Well, good. Well, we got quite a bit going on in the market today. I'm going to run some quick data, but we're going to be talking about force appreciation today. Let me share my screen real quick.
Yeah.
So, a couple interesting things. So, we closed out the month of May. We closed out the May of month. So May single family homes are averaging 51 days on the market, and nothing sells faster than a house in real estate. So if you're selling anything other than a house, it's just going to take longer. If you're selling land or multifamily or even condos multiply, just put a zero at the end, and that's how long it takes to sell a condo, 510 days. So right now, June, we're sitting at 47. This right here is still, don't look at June because June numbers are premature. But in May, houses selling about 90% of what's being, so they're being listed at 492. So
Mhm.
the average house is overpriced, period.
Yeah, definitely.
Right. So now, what does an overpriced property? And remember, whatever you see happens in single family, it's exponential in other asset types. So in May, if you had a house that sold in May, it sold for $481,000. After 30 days, it drops to 411. From 481 to 411 in the month of May. So it's a big drop. If you don't price it right in the first place and it sits on the market, you're going to lose a lot of money.
Wow.
Days, months of inventory, April, we were at 5.9. I need to get that May update. And we've been talking about this. We're following this. Investors, and I know Albert, you're following this because you're building new houses. Um, 50,33 on the market in May, only 8,400 sold. So only
Wow.
16% of the inventory is selling. So out of 50,000, 17,500 were brand new listings. So
Man.
less than half of the houses that hit the market even sell. So for every house that hits the market, I should say it this way: for every house that gets listed, only one sells per month. So we're seeing like a 2 to 1 increase in inventory month over month.
Mm.
Here's what I was wanting to talk to you about is new construction. So we had 8,446 sales in the month of May. Did you know 2,500 were new construction? And I was talking
Wow.
to Corey because he's doing a lot of new builds. He said that number's wrong. He said it's actually closer to 50% because a lot of the new construction sales are not listed on the MLS. I mean, I'm just getting this data off the MLS. So, and then this
Hey,
is
I'm,
what
and
we,
I'm curious. I'm curious, like what that percentage is. I know what he's talking about. Is when you're building, especially when you're building a volume. A lot of times, or when you are focusing on a specific area, for instance, you're an established builder. You're in a certain area. People know you. They know your product. You just put your sign out. Like we were driving through Oak Forest, I think it
Mhm.
was, and I saw the same sign with the same builder name on probably 8 different houses, and the
Yeah,
sign was out there for sale, and they didn't even have siding up yet.
yeah,
So some of these houses definitely, I think, are selling pre-listing
yeah, a lot
before
of
they're,
them.
yeah, before they're even done. So
So the
yeah,
question
there's
is
some
how
truth. There's some
many?
truth to that. Yeah, that's the question, right? Is it? I mean, how do you even get that data, right? Is this
I think the only way we can actually gauge that number is just by going straight to the builders and asking them.
right? But I
because
think it'd probably be like what Corey, I think Corey's is his statement, and I agree with it, is probably more about feel, right?
yeah,
This is what I feel like the market is doing, especially if you're a prolific builder in a
yeah.
certain area. You know, you're going to meet other builders, you're going to talk to other builders, you're going to get like this anecdotal kind of information,
Hmm.
but there's definitely some truth to it for sure.
It, yeah, we need to know the answer. I think it will really help us because for somebody like me, I'm doing this is me in this column. I'm in column E. Now I do have some new construction listed, and look,
Mm-hmm.
new construction's not flying off the shelf either.
Yeah.
Compared to resales, it may seem like that when you look at the numbers, but they're still sitting on the market for, 270 days or so. Um, they're sitting on the market longer from what I've seen. We can dig into that too because um, if you notice, like with a lot of new construction, they'll list it before they break ground, and they'll list it at a ridiculously high number. And the closer they get to completing the build, they start lowering the price. So we see that a lot. But
Mm-hmm.
resale in May, resales sold for an average of 466. I mean, that's stinking high
Yeah.
compared to new construction selling for an average of 393. I read a report last
Yeah.
week that said that new construction is getting smaller. The trend for new
Mm-hmm.
construction is trending downward on size. So, and we're also seeing when we get feedback, when agents show our properties, this is one of the most consistent pieces of feedback is they will say, buyer decided to go with new construction and they're not interested in the house. Um, so that's just a real quick update of what's happening in the market. What does this mean for you as an investor? Well, today we are going to be talking about something called forced appreciation. So appreciation, pretty simple. The value of real estate over time,
Mm-hmm.
it goes up. It always goes up. Congratulations. Cars don't do that. Electronics don't do that. I can't think of any, maybe gold, maybe some certain minerals and some stocks, but real estate is pretty consistent. The value of the real estate. Now, I'm not talking about the cash flow. I'm talking about the value of it tends to go up. Now, what's better than one thing that's better than having your real estate values go up is having your real estate values go up fast. And so that's what we want to talk about is how do we force that appreciation? How do we speed up that? So, Albert, let's talk about so appreciation. Most investors buy a deal and they're going to hope the market lifts it. Now,
Yeah.
some people bought in 2022 and 2023 because things were going up really, really fast.
Yes.
But what they didn't know at that time is that we were at the top of the market, a market that was going to come down. And it
Mm-hmm.
it came down with a parachute. It didn't just
It didn't fall off
free
a cliff.
yeah, it didn't fall off a cliff and die. But it just kind of it's we've been gliding downward for quite some time.
Yeah.
Um so a good operator, this is critical. If you have investment property, you listen to this. You need to listen to this episode because you are responsible for your appreciation. Let me say that again. As an owner of real estate, you are responsible for whether or not the value of your real estate improves. Am I right, Albert? Or you have a
Yes. Yeah.
difference?
I mean, absolutely. Even, I mean, people say, well, it's the market. Well, it's where'd you buy it?
Yeah,
Right. You had that opportunity to underwrite your property and find a good neighborhood or find a good, a good area that historically appreciates, so that's kind of the answer to that question. The
yeah,
market's going to do what the market does. Well, yeah, you're right. We're not fortune tellers,
yeah.
and some of us do kind of take bigger risks and for the big rewards, but sometimes we're kind of left holding the bag too because we took that risk and it just didn't go our way
Exactly.
when
And
you're talking about market forces, right?
yeah, exactly. Exactly. And you can buy that great deal in that great market, in a market that's getting better. and I can still teach you how to lose money in with that
I can
scenario.
too. If you need
You
any
know,
lessons, yeah, my number's on the screen there.
and so we can teach you how to make money in a bad market with when the market's going
Yeah,
down. We can teach you how
for
to lose
sure.
money in a good market when it's going up. That especially as as an investor that's buying and holding real estate, whether it be single family, multifamily, any type of rentals, any type of income producing property, value is a function. I really pray that somebody out there hears this message tonight and their life gets changed because if you think that your property is worth whatever you think it's worth, your financial statement will reflect the value of the property. Let me repeat that. Whatever you believe your property to be worth, your financial statement will reflect it. And it has very little to do with the income. It has very little to do with revenue. And every investor in Galveston, all they want to talk about all day long are the cruise terminals. And that the banks don't care about the cruise terminals today,
No,
right?
no.
It's got to be NOI. If you have something to write write the letter NOI. And if you're driving, just pull over and write this down somewhere. Your NOI, not your income, not your revenue, it's your NOI. That
Hmm.
cap rate has to reflect that. So every dollar of durable net operating income, NOI, gets multiplied at exit. If you don't have an NOI that reflects the value, the gross rent multiplier is only going to help you so much. A lot of people like to say, "Well, I get this much in rent, and so you multiply it by 10 a year." That's not a sophisticated way of evaluating property. The banks aren't going to look at that. They're going to look at what does that property actually produce? How much money does it make?
Hmm.
So today we're going to underwrite that on purpose conservatively, and we respect the loan clock while we do it. So these lenders are going to have final say. Don't think it's a cash buyer is going to come save the day. That cash buyer is going to want a bigger discount.
Absolutely. Yeah, they're bringing speed, they're bringing convenience, they're bringing a higher probability of closing. Yeah, they're going to want a bigger discount.
Yeah, 100%. So, Howard, tell us a little bit. Okay, why does forced appreciation? Why does that make a difference?
Well, I mean, so that like forced appreciation, that's something that you actually can control, right? We kind of touched on it a little bit during the intro. That's something that you can control. The market appreciation, market forces,
Hmm.
even if you're buying in a market, right? That is historically appreciating, right? It's a good neighborhood. Things happen, right? I mean, you can have these black swan events like COVID, things like that can
Yeah,
happen, and everybody's just going to be decimated, right? But the forced appreciation, that is something that you can actually control, right? When on the single family side, right, we're adding square footage, we're doing a higher quality renovation, we're screening our tenants better, right? So our income is probably going to be a little bit higher, right? And you on the commercial side, right, with multifamily, right, you're finding ways to maybe reduce your expenses, or you're going back and talking to your insurance agent to try to
yeah,
control that cost as well, right? Your value add to that property as well. Those multifamilies, maybe you're going to put LVP in
hmm,
all of the units, and you're going to upgrade your ACs and things like that. That's going to run more efficiently, right?
100%.
Those are ways that you as the investor, you have control and you can force that appreciation.
So let's talk about some practical things that we could start doing right
Yeah.
away to force that appreciation. So just like you said, forced appreciation, it's what you're looking at in order to force the appreciation. You're actually taking matters into your own hand and you're forcing it. You're not relying on the market. We're seeing, here's what not to do. Do not rely completely on the market. Let the
No.
market do its thing, but
Yeah.
don't bet on the market,
Right.
right? Because what we're seeing is we're seeing investors, they bought when the market was low and now the values went up, the market's high,
Mm-hmm.
but the property has been neglected and it's lacking repairs and the rents are down and the vacancies are up and it's not being properly managed. And if you have a property manager in place and you feel like your property manager isn't doing their job, you must hold your property manager to the fire.
Yeah.
And if you are your own property manager, would would you hire yourself? You've
Yes.
got to ask, do you feel like you're really doing a good job? Are you collecting payments? Are you do you know what the average vacancy rate is
I
in
mean, if
your
I were looking at me as a property manager, I'd be like, are there two of you? Like, well, I'll
yeah,
take two, please. All right.
yeah, exactly.
Yeah.
Exactly.
Yeah.
That's why you're the co-host of the show, Albert, because
Yeah.
you know, but
I love what I do. Yeah.
you got to love what you do. And if you don't like that part of the real estate, leverage it out. And it
Absolutely.
but Albert, I would tell you, you are a hard person to clone. Okay? So let's talk about I do want to talk because you bring up a really really important point because not just with residential real estate, but we see a lot of time in the commercial world. We see in hospitality or industrial where an owner is has a business.
Mhm.
We see a lot of times that the owners of these businesses are trying to sell their business and they can't because they
Mhm.
can't clone themselves. The value of the business, the reason the business is valuable is
Is
because the
because of the
person
person.
running it is good at what they
Yeah.
do,
Yeah.
but they're not sticking around when they sell the business. So, yeah, you need to find a way to clone yourself, brother.
I'm
It's
working on it.
one way
I'm
or
definitely working
another.
on it. Yeah.
Yeah.
I'm getting there. It's
A,
baby
bu- a,
steps
a business worth selling doesn't require the seller to stick around.
for sure. No, that's a good
So,
point.
so value, it's going to equal your net operating income divided by your cap rate. So, if you're at a 10% cap rate and you're saying my property is worth $2 million, dollars, you're going to take the $2 million, dollars, you're going to you're going to multiply it. You're going to multiply it. I'm going to go backwards. If you think your property is worth $2 million dollars and you multiply it by an 8% cap rate, you're telling me that your net out your profit is $160,000.
Per
But
year.
if you're like, well, it's not 160, it's like 60. Oh, it's 60. So if I take that $60,000 and I divide it by 8%, your value, your property is not worth $2 million. Dollars.
Oh, wow. It's worth a lot less.
It's worth $750,000. So here you have two options in this case. So this is
Options.
this is 90% of all scenarios. Your options are A, list it and don't sell it, or just don't sell it. You can list it. It's not going to sell. If you think it's worth
Not for $2 million. dollars.
2 million, you can either find a way to get that profit up to $160,000. You may need a coach, you may need some advisors, you may need some friends to help you, and or B, just sell it for what it's worth. It's worth $750,000.
Sell it for 750.
Well, but Albert, I've put so much time and energy into this. I've put my blood, sweat, and tears, and I've done so much work, and nobody's going to work harder than me.
Well, then keep it and give it to your kids. I don't
Yeah,
know. you
yeah.
know,
I don't know
but
if
no,
is that a
no,
blessing or a curse.
that's a horrible answer. That's a horrible answer there because I know we're going to talk about ways how to increase that value of the property of that commercial property,
Yeah,
right? Yeah.
I don't think that's a bad answer. Honestly, I think with some cases, people will find over time that it can be very personal for somebody that has you got to give somebody credit where credit's due. When you take put all the time, work, energy, blood, sweat, and tears into building a business, and that's what a lot of Americans, hardworking Americans, are doing every day.
Hmm.
And they're providing a living and a life for their family. Like that's all commendable, and that's kind of what built this country. 250 years, brother. We're almost there. And
Almost there.
but man, you just can't sell it. You just can't sell that. Like it may be a good, but you haven't really created a business. You created a job for yourself, and you can
Yeah.
give that job to somebody else, which is fine. So, so where we were talking about. So the way to get that value is to take your net operating income divided by the cap rate, and if you think your property is worth something, start with that number, and then multiply it by the cap rate. And that's what the NOI, that's where you should be on the NOI.
Oh,
So,
okay.
so, uh, why does a dollar, here's my question. Maybe you can answer this. Why does a dollar of NOI matter so much more than a dollar of one-time cash?
Well, that NOI, like that's just going to go on, right? Repeatedly, right? Your
Yeah,
NOI, your income, that's going to be like every month you're getting that as opposed to just getting $1 one time,
yeah.
right? We talked about that, or we're talking about that now, right? It's durable. That's the term that you used, right?
So either you're working for money or you're getting to the point where your money's working for you, or even better, you're trading. You can either trade your time for money,
Trading time for dollars, right?
trade your time for dollars, your dollars for time, or your dollars for dollars.
Right. We
And
want
that's
that income. Like income is repeatable,
it's
right?
repeatable. You're trading dollars for dollars. You're basically it's a money machine if you do it right. So
I like money.
exit cap rate. So your exit cap rate, that's where we want to get when we exit, when we sell the property. What
Mhm.
is the exit cap rate? Or how does the exit cap, how does that change the whole picture?
So
Does that
the
make
cap
sense?
rate goes up over time, right? You know, and just kind of from an investor who doesn't really invest in commercial real estate and large multifamily or larger multifamily, um, is it true like the higher the cap rate, kind of like the riskier the investment, right? But
Yeah.
also the potentially higher reward or return. Is
So,
that also
so
true?
yes, that is very, very true. However, that's more of a general statement than a specific statement.
Okay.
That principle doesn't apply to how good of a deal you got.
Okay.
Um, I'll explain. So if you go like A class, B class, C class, A class being your high end luxury, and C class being your, economic. C classes typically need more attention. They're going to have uh, more maintenance issues. They're typically going to be older properties.
Mm.
So yeah, there is more risk to that. Um, However, like your A class typically is brand new. It's very minimal attention required to maintain it. Your return on investment, your income on a class is going to be lower percentage wise.
Right.
And in fact, in a lot of luxury markets, it's not even a break even. It's not even a break even in a lot of point, but a lot of places. But the reason those investments are attractive is not because of the cash flow; it's because of the appreciation.
Got it.
So yeah, yeah. What you want to know about cap rate, if you're buying multifamily and you're in the Houston market, I'll speak to what I know. Cap rates are right below 8%. And
Okay.
that number is going to be pretty consistent. But
Just no matter where you're kind of investing in Houston, pretty much, right? Because we don't
yeah,
really have pockets that are going to deviate much higher or lower than that, right?
no, because it all goes back to the bank requirements, and it's I mean, the bank doesn't care. They're wanting to see, no matter what asset type or what, property type, they want to see a certain return on their investment.
Got it.
So, so no, it's going to be kind of all over. And so knowing that, I was going to say, if you buy a property and you want to know a couple of things about the market that you're in. Number one, you want to know about what the cap rate is on almost every commercial asset, especially. Um, did I just disappear? Hold on a second.
No, I got you, bro.
Okay. I'm having a technical standby. Okay. Your cap rate on a vacancy of 45% vacancy is going to be a lot different than if you have a vacancy of 90. And the second number you need to know. So number one, you need to know your cap rate, but number two, you got to know what that vacancy rate is
Uh-huh.
on those properties. So Albert, you do a lot of short-term rentals. Does
Yes.
does that number matter when it comes to
Yes, yes.
buying a short-term rental
And thing
investment?
about with short-term rentals is definitely varies from really zip code to zip code, depending on what's nearby. is it an area that is attracting travelers, or whether it's maybe it's midterm, are they business travelers, are they near the medical center? I mean, those things really matter, because once you kind of get outside of those areas, then your vacancy can go up dramatically.
Yeah.
And that can definitely have an impact on your overall numbers, because that's just going to impact your income, right? You plug that in though when we're trying to understand and we're underwriting these properties. We definitely are interested in vacancy.
Yeah.
On long-term rentals, it's a lot different. I will say that. It doesn't vary as much. There's not just a huge swing from
Hmm.
neighborhood to neighborhood, zip code to zip code, right? It's probably anywhere from 3 to 5%, might go up to 10%.
Yeah.
But with you're talking about Airbnb, short-term
Yeah.
rentals, things like that, you can have 50% vacancy, right? You can have 60% vacancy, or you can have 40%. Those are some really big numbers,
Yeah.
some big swings.
So I love that. That's critical. So obviously with longer term rentals, you you got to know this number, vacancy. And you
Mm-hmm.
got to know what that looks like for your specific asset type. What I hear you saying was with short term rentals, those vacancies can vary just based on the city or the submarket that you're
Right.
in. Knowing what that vacancy, the reason why that's important is because you can say, okay, I am in, let's pick Galveston. I think Galveston probably is at a 45 to 50% vacancy on short-term rentals over the last two
All
or
right.
3 years. You may be able to clarify that.
I can bring up some data. Go ahead.
You can break that down even further because your vacancy on a five-bedroom house is going to be different than a vacancy on a three-bedroom house. Am I right?
Yes,
Okay.
that's right. And location matters
So
too. Right?
the reason you want,
Your vacancy on like a midtown property, which is kind of closer to Broadway, is going to be much higher than your vacancy on a beachfront property,
right,
right? No
exactly.
matter the size, right?
So what do you do with that vacancy number? If you are in industrial real estate and you know that vacancies in industrial are hovering around 8% vacancy, you're going to look at the asset that you're investing in and you're going to take that vacancy rate. So let's take Galveston. Let's say 50% just for, and I'm looking at a property in a market that averages 50%, but that property is averaging 25%. So it's performing at like half of what the market. So you already have what we call a value add opportunity. Your first opportunity right there to add value is just to get the occupancy up.
Mm.
So how
Right.
do you get occupancy up, Albert? Short-term rental. You inherit a short-term rental that's performing at 20 to 30% occupancy. How do you fix that?
Well, what I'm doing first is number one, some low hanging fruit. What do the pictures look like?
Hmm.
That's low hanging fruit. Are they professional photos? Are they iPhone photos? So we're going
Hmm.
to upgrade that. We're going to get professional photos done. We're going to look at the overall property and look at the properties around. Like, who are my competition in this particular area? How is my property set apart? How do we set our properties apart? By the amenities that we offer,
Right.
right? Are there any of your competition have a hot tub? No. Great.
Hmm.
It might be a good investment for you to have a hot tub. We have a friend who invests in Galveston. She has several short-term rentals and manages several short-term rentals. She's got a hot tub and an infrared sauna outside,
Nice.
right? And I haven't seen any properties that have those things. So that's how we're going to set those apart to decrease our vacancy, right? We want to
Yeah.
increase our occupancy. So amenities, your photos, and then your property management, right? Your property management, if it is horrible, they're not vetting guests properly, they're letting guests have parties, they're getting negative reviews, that's going to push you lower in that Airbnb algorithm, and your vacancy is going to remain high. And then what you're going to end up doing is you're going to end up dropping your price so far to where you're going to probably continue to get horrible guests, because you're in a different price
Yeah.
point pricing tier, just because you're trying to get some good reviews, or you're getting guests that don't know how to review. I can go on and on, but those are just some things,
Yeah.
right, that you can do right away to increase your occupancy, reduce your vacancy.
Yeah. And all of that is marketing.
Marketing.
Even the hot tub, even the amenities, because those are features and features is part of marketing.
Absolutely.
and finding ways and strategies to get your guests to come back.
Hmm.
The the other lever, so we talk about occupancy, rental income. So three things you need to know is occupancy, and number two is rental income, whether this be again multifamily, an office building, or a short term
Short term,
rental.
long term.
You need
Yeah.
to know what's possible with rent,
Mhm.
right?
Yes, right. I mean, and so the rent, those are some things that you have some control over. But when I think about rent, I'm also thinking about market, right? The market rents
Yeah.
is what will the market support? Just like when someone asks you, Austin, what's my house worth?
Yeah.
Whatever someone's really willing to pay for it, that's what your house is really worth. How much rent can I get? Right. If I'm in an area that rents are going for about 1,700 for a 3 bedroom, and I'm trying to get 2,000, I can take a shot, but like you said before in the intro, if I'm overpriced, that thing's just going to sit there longer.
Yeah.
Yeah, I'm gonna have another mortgage that I need to pay because I can't find a good renter that's going to pay that amount,
Yeah.
right? So those are some that market is going to really kind of control like what your kind of ceiling is. All right. And it's our job as investors to make sure we get close to that ceiling, maybe kind of push the boundary a little bit. How do we
Hmm.
do that?
Yeah.
Again, what does our property look like? Right? Is it fixed up or do we have repairs and maintenance that need to get done? What's the curb appeal? It's like we're kind of selling the property, but we're not. We're just trying to rent it. But we want it to just be nice and everything to work and everything to be
Yeah.
clean. Right. You don't
Yeah.
want to have roaches crawling across the floor when you're showing the property to a prospective renter. That's how you can get your rents up. Same thing
Yeah.
on the Airbnb side, right? We talked about higher occupancy. The higher occupancy, you can start to increase your average daily rate, right?
Yep.
Those goes up, and then your income ends up going increasing.
Yeah. So most of the time when we run into this issue, we look at it's like you're looking at two columns. A, this is what the market is. B, this is where you are. So A, the market has 50% occupancy. B, the property you're buying is at 25%. That's interesting.
Mhm.
Next one, rents. Market has average daily rate of $300 per night. This person is charging 200 and you're about to buy the property from them. There's an opportunity. That's interesting. Those rates are low. In some cases, we find the opposite. We find a market where the average daily rate is $300 a night and the owner of the property is charging 500. Like they're overcharging. And so
Yeah,
that's going to reflect in the occupancy. So by knowing that numbers, I mean that's going to tell a really clear story. If you're charging 50% more than the average daily rate and your occupancy is half of the market, there's your problem. You're just
yeah,
charging too much money. Well,
yeah.
it's really nice, and I put my blood, sweat, and tears into it. Well,
Yeah, yeah, that,
cool
and
story,
that's
bro.
normal. I've sat in on interviews. I've been interviewed, but I'm also interviewing potential co-hosting clients that are looking for a co-host, and I ask those questions. I ask them about what's your average daily rate. Some people don't know that because they're not that into the numbers. They just have a feel of what they want to charge guests,
Yeah,
and they're looking for a new property manager or a property manager because they're trying to understand why aren't they getting rented out.
yeah,
And a lot of times it's because you're too expensive. The
yeah.
market is not just going to support that because you think it's worth that. Yeah, that happens a lot.
That goes back to why it's so important to have a wonderful, amazing property manager, Alberto. Somebody like you, somebody that basically says, A, here's the market. Here are the market occupancy. Here's your occupancy. That's different. B, here's the market rent. Here's your rent. There's the difference. And then C is your financials. Any other income, your average, and you should be able to do this on like AirDNA. You can certainly do this on CoStart when it comes to any type of commercial asset type. But what do market financials look like? And the market financials will tell you based on your average income. This one's the third one I'm going to throw in here is what does the average expense ratio look like for that asset type? So
Mm-hmm.
let me break that down. I know in multifamily, average expense ratio is one of the most consistent data points in the multifamily space. It's right around, it's in the low 60s. It's like 61 or 62.
Okay.
that your expenses, like you should know, and by knowing that number, like we can do this math in our head almost, but by knowing that number, it is you should have a profit ratio of 35 to 40%. And that
Hmm.
probably applies to most asset types. I don't know about vacation rentals.
Vacation rentals is a lot lower. Vacation rentals, because our profit, I'm sorry, our revenue is much higher. So our expense ratios is usually between 30 to 40%.
Yeah.
Yeah. I mean, if you really have it dialed in and you're getting the highest average daily rates and you're getting your supplies and everything, just everything dialed in, you get that about 30%.
So taking those four criteria, you can evaluate the opportunity, the value add opportunity. So if their rents are low, number one. Number two, if their occupancy is low, and then number three, if their expenses are high. And now, based on this, you should have a gauge which to measure those things. It doesn't mean pro forma. Pro forma
Right. No.
means the seller's going to do what they can to sell you on pro forma.
Yeah.
Every seller, not some of them, not some of the sellers. 100% of the sellers are going to sell you on pro forma.
Oh yeah.
They're going to say something when they're trying to sell, whether you're an agent listing a property or an investor buying a property, or whether it's you lying to yourself. You're going to say, well, this property should be producing a net operating income of, $250,000 a year. Shoulda, woulda, coulda. It's not going to get it funded by the bank. So if you really feel like that's the case, let's make it happen. Let's do what we need to with the property. So my question, why do so many deals fall apart when you underwrite based on the current performance of the property as opposed to underwriting it on the pro forma?
Wait, why do they fall apart? Well, I mean, if I'm underwriting a deal, I want to look at in place, right? I
Yeah.
want to look at in place numbers. That's what you just discussed.
Yeah.
I think deals fall apart, or when I'm talking about a deal, I'm sorry, here's a buyer, here's a seller, they're just not going to meet because the buyer is I want to look at all your current data, right? Your T12s, your expenses, your insurance, your taxes. Like, let me look at some bank statements, right? Let's look at your rent rolls, all of those things, right? That is
Hmm.
that is a snapshot of your business today,
Right.
right? Now, I've got a pro forma as an investor.
Sure.
I've got a pro forma that I'm really not sharing with anyone because that's my business plan. How am I going to position this property? Right.
Hmm.
Here are all the opportunities. You just listed them, right? You're talking about rent. You're talking about occupancy. You're talking about your expenses. Okay. Those are all opportunities that I know that I can improve, right? All of those things. So I've got my pro forma of how do I think this property could perform once I buy it and I take
Yep.
it over, right?
Yeah.
So those deals fall apart because that buyer and seller, they're just not seeing eye to eye. Because you mentioned it, that seller is like, well, no, this property has a lot of potential. You
Hmm.
know, it is an amazing property. Like I've heard it all, and that's when those deals just kind of fall apart. And then, but you stay in contact with those people,
Yeah.
and time and circumstances changes everybody's situation.
You hit the nail on the head. That this is a relationship building
Mhm.
business. And
Yeah.
yes, sometimes it does take a long time for those opportunities to turn into something, but they certainly are there. So let's talk about expenses. So one of the challenges that we face, not just we can start with short-term rentals, we can talk about long-term rentals, commercial assets, but across the board, expense management, expense control is is a challenge.
Mhm.
It's tough. And thinking about it from a buyer perspective, you can identify pretty quick. Most buyers can identify like where they can cut expenses. But the thing is, the buyers, they're not going to say anything. Like you're not going to tell the seller, "Oh, I think you can reduce those expenses by
Exactly. Yeah.
50,000." Like you're not going to tell the seller that because then the seller's going to think you think it's worth more than.
Right. Yeah. Yeah.
So
That's your business plan as an investor. And again, like I is those are things that I'm putting down. Again, how can I improve those things? They're not guaranteed either that I can improve all of those things to the degree that I want to. Right. When I'm underwriting, I'm being conservative. Okay, can I save 50K, or is it more realistic? I can save $10,000
Hmm.
on insurance.
Yeah.
Well, I'm finding that information out up front. Cool. Now I've got a little bit of data, right, that I'm holding close to the vest when I'm underwriting this deal. Great. This deal it got a little bit better because now I
Yeah.
know this person is paying 30 grand for insurance on this multifamily, but I can probably cut that in half
Yeah.
because they're overinsured or they're double insured or something is just going wonky with they haven't priced anything out in the last 20 years,
Yeah.
you know.
And
So
I think that like CoStar, those financial reports on CoStar, they won't tell you what your insurance will be, but they can tell you on average what percentage of that asset type's revenue is going toward insurance. So that's
mm-hmm.
always a good kind of gauge. Just, like what's the percentage for utilities? What's the percentage for maintenance costs? What's the percentage for taxes? You can break those back down by percentage points so you can get that 60%,
Yes.
right? So
Mm-hmm.
so let me ask you this, Albert, because we got like 2 minutes left. And if you're on the call, you have any questions, you want to come off, feel free to ask or type it in the chat box. Would love to hear from you. If not, I want to ask you this. What expense lines, like what's the first things that can usually be cut in an investment property when it comes to expenses? What are the first expenses that can be cut or looked at?
I'm looking at insurance. I know we've been talking about insurance a lot, because for me, that is just where people get lazy or they have awful insurance brokers. They haven't, they don't go get these things priced out every year, and they just take the increases,
Hmm.
and I mean, not everybody needs windstorm insurance,
Right.
and there's other options for windstorm and things like that. And I'm talking about windstorm because this is the area where we invest here on the Gulf Coast, but I'm usually looking at that insurance line first. um, a lot of everything else, to be honest with you, is kind of, maybe there's just a little bit of give and take, right, of push and pull,
Yeah.
or gives and, or what do they call, puts and, whatever. Anyways,
Ebbs and
where I might be
flows.
able to save a little bit on some expenses here, but
Yeah.
these other expenses might kind of go up and it might be a wash, right, so to
Yeah.
speak. But I'm usually looking at insurance. Now, when I'm going to go finance the property as well, maybe my financing terms are better, right? Because that kind of goes into it as well, right? I've got my NOI, but what's my mortgage expense going to be, right? Am I
Yeah.
financing this at 6.5 or 8.5? I think I have a property financed at 8%. I just can't wait to get through this prepayment period where I can go, just refinance this thing and
Yeah.
save a little bit of cash every month. But anyways, I'm looking at insurance. Usually I'm looking at that first because that's usually the place where I can get the biggest bang for my buck,
Yeah.
where I can actually save real dollars. Everything else is just a little tweaks here and there, but over a portfolio, right? It makes sense. I'm
Yeah.
looking at everything. I'm looking at all of our expenses. I'm repricing out, for our short-term rentals. I'm repricing out electricity plans every year. I'm just gonna go check it out. Or if I can get locked in for 5 years at a good rate, I'll go get locked in for 5 years at a good
Yeah.
rate. Right.
Yeah.
But your property manager is either going to do that for you, Austin, or you're doing it for yourself or your portfolio. But I will tell you, a lot of investors, they don't care. They have this automatic draft, and these expenses are just coming out of their account, and they're not really auditing their properties properly. That's why it's good to have a good CPA. You're looking
Yep.
at your portfolio, you're reviewing this thing either quarterly or at least twice a year. Who are your winners, who are your losers, what are you going to do with the losers, and how are you going to reposition and improve those winners, right?
Yeah.
That's how I look at it. So long
There's
answer to your question of how do I what expenses do I look at first?
Yeah, insurance, taxes. Sometimes taxes are
Taxes.
high. They can be
Yeah,
protested.
definitely.
Um, Payroll can sometimes be a big one. That usually
Mm-hmm.
is some type of property manager or other stuff. And then like utilities, there's always opportunities. And then below the line, it's just financing terms too, below the line, looking at
Yeah.
opportunities there. So we can get, we have so much more to talk about when it comes to underwriting. The financial side of it can be just a completely different, you know, different episode as we get into like DSCR and financially
Hmm.
how to underwrite these deals. Like this is just step one. So I would, you know, look at your market, how it compares with your property. What are the vacancy rates? What are the occupancy rates, market versus your property? What are the average daily rentals or the monthly rentals or rental rates,
Hmm.
and then
Your expenses. Yeah.
expense ratios. So
Hmm.
know your numbers. By knowing your numbers, you're going to be a more empowered and successful investor. So stay tuned. Next week, we're going to talk about stress testing deals and downside scenarios. So we
Hmm.
always want to expect the best and prepare for the worst,
All
right?
right, I've got a few downside scenarios I can bring to the table.
Okay, well, let's break it down. If you have a downside scenario you want us to look at, and then in 2 weeks, we're gonna do some live multifamily portfolio deal reviews. So we're
Nice.
gonna break down some multifamily, and that's it. So some exciting stuff for the month of June, and then
Awesome.
July we'll get back into financing and capital strategy. So we're looking forward to the next to our summer series. Albert, my brother, appreciate you very much. Any final thoughts?
Oh man, we got to have lunch soon. That's my
Let's
final thought. We got to
let's
catch up.
let's go. You need to come by our new office.
Okay,
If anybody wants to come see our new office, call me. We're at the Green Street Tower by House of Blues now, and
cool.
it's nice. It's soundproof. You can go into a room and scream, and nobody knows.
It's the market's not that bad, buddy. Come
No,
on.
no, it's all good. It's
Yeah,
quiet. I can talk on the phone and not hear
that's cool,
dogs
man.
barking, so it's great. So,
Awesome.
all right, be blessed. Have a wonderful week. I'm Austin from Houston. Don't forget to like, subscribe, make some comments, trash talk us on YouTube. Just be there, be present, get involved, network, connect, and we'll see y'all soon. Bye.
Yeah.